Proshare, a financial information hub, formally launched the second edition of its Tier 1 Banks report titled Reassessing Tier 1 Banks, the New Class of 2023. It was an opportunity to examine trends and developments reshaping the banking industry in Nigeria. Mr. Tosin Ige, Head of Research Services Proshare, in the presentation on Macroeconomic Review and Outlook of the report, highlighted the market impact and keynotes for the economy.
Let me move to the Nigerian economy. Now, the presidential plan suggests a pro-market policy across the policy action if you go through that. But, of course, if you review the 1 year, what we have between this same period last year and now, what we observe is that the situation has become dearer for us as a country. And so, let's focus on the trilemma. Focusing on the trilemma, we'll see that inflation, the interest rates, and of course, the exchange rate all has become dearer. But of course, to better give us an understanding of the state of play, what we did is actually a pested analysis. And then, of course, this is also, we did it in two, looking at the current reality and then the outlook, and we also have the policy response. But of course, the pested analysis that we have here, in terms of the politics, yes, we are able to achieve our 9th democratic transition. But of course, you and I know that trust deficit is still on the rise. And of course, again, the disenfranchisement that we see, of course, is notable in the economy now. And of course, when we look at the economic aspect of it, the trajectory of growth is still under threat. When you look at the social bond, was stretched during the election and is still there. In terms of technology, we are seeing the evolution of AI and other technology driving financial institutions, and that's why it's a major composition of our report this year. And then when you look at the environment, we think the global economy, yes, there is that climate change on the global economy, but we think actually that we are overstretching it for Africa. For a country like Nigeria, it's not really a major consideration for us. And then the legal system, yes, it's there, but of course, it's complex, yet it is not supportive of business. And insecurity, insecurity at this period is there, but we dare say that it is actually underreported. But to sum it all up, let's look at our outlook for the macroeconomy. What we are seeing here is that if the current policy ambiguity continue, these are the likely outcome that we feel we will likely see. And if we get it right, and that on the other side is what we feel the outcome will be. But whether we get it right or not, we think 2023 is just, it's almost ending. So, but of course, if we get it right now, we're likely to see those positive outcomes in the coming year, 2024. So that's basically what our outlook is.
In his presentation on the Tier 1 Banks report, Mr. Teslim Shittabey, the Managing Editor and Chief Economist, Proshare, emphasized the banking transitions and the Proshare Bank Strength Index ranking for Tier 1 banks.
What actually is a Tier 1 bank? And why is Tier 1 bank static? AfriInvest introduced an interesting concept, FUGAS. FUGAS was an acronym for First Bank, UBA, Guarantee Trust Bank, Access Bank, Zenith Bank, and Echo Bank. But that categorization was static because for 10 years, we had the same banks being categorized as FUGAS, Tier 1. While we were doing our analysis, we said, wait a minute here. We are seeing some challenges with having a static metrics for Tier 1 banks. And we decided to tweak the AfriInvest model a bit. So we did our first report in 2021 with 6 criteria. But as in all things in Nigeria, there was a feedback. And we decided as Proshare that that feedback was relevant. So the feedback talked about needing to broaden the criteria for assessing what a Tier 1 bank is. Now, fit for purpose classification and calibration was very important to us in our assessment of what a Tier 1 bank is. And because of that, we decided that we will break from conventional methodology to a new methodology that emphasized this evolution of the banking phenomenon. Now, enter the period 2022. In 2022, we decided that we were going to add a few other matrices. We needed to capture risk. We needed to capture assets because we pivoted a bit from AfriInvest. We felt, okay, AfriInvest was too heavy on assets, so we should maybe tone down assets as a metrics. However, again, as a result of feedback from CFOs, they felt, no, the assets still are important. So we still brought it back in. So we have that there. Then we had asset quality. Then we now brought in profitability, efficiency, cost to income ratio, digital income, and then governance. Now, governance, what we did in governance was to introduce the independent non-executive directors. And we used that as a proxy for improved governance. Of course, we could argue other matrices, but this is what we used for 2022. So how do I know whether I'm a tier 1 bank? Now, these are all the matrices we used, 10 matrices we used for 2022. Now, we use the percentile method. And before we got to this percentile method, we did something. One of the things we did was this. Some of us who are maybe statisticians will recognize the concept of a panel econometric model. What we did was to be able to identify coefficients, and those coefficients across 3 years and across banks, so that we can get those coefficients we will attach to each of these variables. And that was the basis of our percentile rating for each bank. Now, if our cutoff percentile was 50%. If you're above 50%, you're tier 1. If you are below 50%, you're tier 2. If you have negative shareholders funds, you are tier something. Well, you're tier 3 actually. If you have a negative, shareholder fund. Now, the layout for the report was basically this. We had an introduction with a global banking industry analysis. We went on to look at the state of play of banks in Nigeria. What's the state of play? How are banks interacting with themselves? And how does this bode for the future? We also took a fresh look at our methodology that I have described. So we tweaked our methodology. We also did a financial risk assessment of the banks, because risk is becoming increasingly important. This is the percentile ranking we had. One thing I'd like to say is that we expect at least 2 banks to qualify for tier 1 status, in addition to the previous banks, based on the performance we are seeing so far. But if you look at between 2021 and 2022, this is the state of play of the various banks based on our percentiles. We expect to see financial adaptation. We expect to see service extension, service and product extension. We're expecting to see the banks or bank service providers closer to the customers and understanding the needs of those customers. One of the things we've looked at in Proshare is that this seems to be the architecture of the market today. But we have argued that there might be a need to retweak this architecture because banks are evolving into holding companies. And as they evolve into holding companies, their operations become more complex, and the regulatory governance also changes. So we expect to see that rather than have this nice, but perhaps not fit for purpose structure, there will be a change in the structure where we argue for a similar structure to what you have as the Financial Service Commission in the UK, where you have monetary policy handled by the central bank and governance and regulatory issues handled by separate institutions. Here is a snapshot of where we are today in respect of the Proshare Tier 1 banking situation. We have Access Bank moving down to 4. We see UBA going up to 1. We see Stanbic IBTC holding fort. Then we see Zenith moving from 4 to 5. GTB or GTCO, as we call them now, moving from 5 to 2. Fidelity at 6 is out. However, like I said, when you look at H2 2023 and the relative positions, we expect that we will begin to see some changes again in H2. And therefore, while we thank AfriInvest for shining the torch, Proshare has decided to stand on the shoulders of the AfriInvest giant to see further. Thank you very much, ladies and gentlemen.
The event featured a panel session that discussed Banks Are Dead, Banking is Reborn, bridging regulatory compliance, changing business models, and rising expectations.
Based on the crisis in 2007, there was now a need for a change in the thinking around the regulations of the banks. And that was part of what informed the Basel 1, 2, and now the implementation of Basel 3, which is currently running concurrently with Basel 2. And what is the focus of that regulation? It's basically trying to see how banks can be well more regulated, how they can manage their risk, and as well as trying to see that they are sustainable in business-wise. So we have continued to see that even the economy is also evolving, and there's a need to change the way risk management is being done.
First, I would say group-wide risk management. That can't be overemphasized. This has been something that has been mentioned, across questions that have been asked from the panelists. So first, because of the need or the growing shift to increase the structure to getting other non-banking subsidiaries into the holding structure, it is very important to pay key attention to the risk assessment and risk management, especially because the banking subsidiaries still account for the largest percentage of the total holdco structure, whichever way we see it. So now there could be these ripple effects from whatever economic shock that happens to the banking sector. So it's important for the management of the banks to properly manage risk, properly effectively monitor the risks in order to be able to curb the shocks from respective, either the banking subsidiary or the other non-banking subsidiary.
Nigerian banks invest a lot in strategy thinking, strategy formulation, and execution. At least within that space, I've been there in the last 34 years. So I observe our banks. They invest a lot in strategy. And that brings a lot of value on the table. So when you therefore see the banks performing, outperforming the economy within which they operate, that also is one of the major factors. All right? Now, talking about risk management, which is the issue for banks now, what it means is that, my sister said earlier on, banks need now to manage more effectively and efficiently their balance sheets. She used the word sweating. And I was happy when I heard her say that. They need to sweat their balance sheet, more. But in the process also, ensure that all those things you've always known about asset and liability management, they need to continually, disrupt that space. In which case, new thinking and fresh thinking in that regard.
Basel has come in to play a role. Initially, before the collapse, as in the crisis of 2009, we saw a lot of focus on Basel I, just capital. There was no minimum being set. But what we've seen more is with Basel II, in trying to correct the issues of 2009, we've seen that it's addressed a lot around minimum capital adequacy of organization, how you're assessing yourself. In terms, all of it has been how you're internally assessing, which is where the ICAP comes in, internally assessing your capital adequacy, how you're looking at it. All these are capital risk, and other financial risks are being considered by Basel II. But with the collapse of those organizations, especially when we look at Silicon Valley, we'll realize a very important component that we've not been emphasizing on is what Basel III is preaching now, which is the liquidity. You can have adequate capital as a bank or as a banking institution, I'm trying to use your terms now, and still collapse in a system because liquidity has become a key component, because how do you match your books? The mismatch of your books becomes a fundamental issue, which is where Basel III has been able to help us introduce the LCR, which is the liquidity capital ratio, and the net stability funding ratio, all of them looking at either the short-term funding or the medium to long-term funding?
If you look at the shift we've had in exchange rate, it has become compelling for banks to, the capital outlay for transaction, the ticket value of transaction has increased in the country. It doesn't necessarily mean that the banks are under regulatory capital pressure, but the banks become under operating capital pressure. Let me use an example. A mid-tier bank will give to a mid-sized oil and gas operator $30 million line, maybe 2 years ago. $30 million line now amounts to 30 billion naira. To bring in a single cargo of PMS, which is about 15,000 metric tons, will require about $15 million FOB. So if a bank has to fund it, then the bank will certainly require additional operating capital. Another factor you have to consider, so the banks have a compelling need beyond increasing their liabilities, also increase their operating capital because of the shift in exchange rate. And if you recall, the central bank came up with some forbearance to the banks, and they were not definite on the timeline for those forbearance. They said they're going to grant bank forbearance on single obligor limits, non-performing loans, and I say you need to specify a timeline because they have to remedy it. If there's a breach of single obligor limit and you're granting forbearance, then it simply means that the customer has to pay down that loan for him to come within the limit specified by the regulator. And if you don't, there are people who have $100 million line from banks have fully been disbursed. $100 million is how much now? That's 1 trillion naira. Yeah. So what is the capital base of a bank that it can accommodate that? It's not something you grant forbearance. Something has to adjust. And that adjustment can come in the form of the customer pays down or the bank increases its share capital.
Chidinma Ayanlewechi, Research Director, Banks Directors Association of Nigeria, also provided an intervention on the work of advocacy with Proshare in the banking industry.
The impacts on banks' profitability and bridging the compliance gap for regulation in Nigeria. It is important to understand the Nigerian regulatory landscape in which the banks operate and also examine challenges posed by some of the regulations guiding the operations of banks in Nigeria. As part of the Bank Directors Association of Nigeria's agenda this year, our focus has centered on advocating for the interest of banks in Nigeria. And one of our primary strategic initiatives is championing a comprehensive review of regulatory charges that are imposed on banks. And to this end, we have collaborated with Proshare to publish a report titled Between NDIC and AMCON, Recalibrating Regulatory Roadmaps. Within this report, we have identified the imperative need for certain regulatory reforms that potentially enhance banks' financial performance. And which research has shown that regulatory charges constitute a substantial portion of banks' annual operating expenses. And while banks remit approximately 0.3% to 0.5% of insurable deposits as premium to the Nigerian Deposit Insurance Corporation, NDIC, they are also obligated to allocate 0.5% of their total assets to a sinking fund to pay off AMCON intervention payments related to the acquisition of non-performing loans.
Mr. Johnson Chukwu, MD CEO of Cowrie Asset Management, Dr. Biodun Adedipe, CEO and Chief Consultant, BA Consult, and Mr. Tosin Ige, Head of Research Services, Proshare, speak on the Tier 1 Banks report and the value of the banking industry and economy.
One report that I can see that is beginning to not hold back to the previous historical practice. And it's saying, look, the world is dynamic, the economy is dynamic. What are the transformation? What should be the new metrics to measure banks? And it's recognizing those new metrics and beginning to measure banks using those new metrics. And it's also dynamic in the sense that they continue to change the parameters in tandem with the evolution of the Nigerian economy. They are looking at, if you look at that report, the summary of the report, they say, look, the next 2024 report, they're going to even look at use the premium that banks pay to NDIC, because NDIC has now adopted risk-based supervision in assessing the bank's insurance premium. And that will be a criteria to determine how effectively the bank is managing its risk. So the reality is that this is a very forward-looking report. It's something that shows the dynamism of the entity and gives anybody who understands the financial service industry the opportunity to actually use the proper metrics to measure the standard of banks.
Sustainability for banking comes from two perspectives. One is thinking of sustainability in the long term, and that means, as the report highlighted, banking would always be required in the contemporary economy, like I said earlier at the panel discussion. But equally, the banks operating within that system now might not be the ones we see in 100 years' time. So in which case, how do we ensure that existing brands actually deepen their practice? That is one side to sustainability, that they are still there in business decades from now, rendering banking services, which will remain evergreen in the contemporary economy. Now, the more fundamental one is the transition in response to climate change, where you now look at the 9 principles of sustainable banking. And that means what should each bank do in order to ensure that it is playing in line with those 9 principles of sustainable banking. And that means the more they pay attention to those, the more relevant to the evolving environment they become.
Every report has its peculiarity, and then, of course, in the maiden edition, there are metrics that we used, and of course, verified to be standard. But of course, we had inputs from our industry players, the CFOs of banks, who suggest that there are more things to, calibrating banks. So, and we aggregated all of them to expand the metrics. So, this period we brought in profitability, and then we also go ahead and with the risk metrics, introduce the risk metrics, and also efficiency. Also, that's why we had the like of a cost to income ratio in terms of the analysis of the report. And so then what it then means is that there's a redistribution of the metrics. So those that have higher weight in the previous edition may actually have a lower weight now, just like the Afri-Invest metrics that started it all, where a large weight was apportioned to asset size. And so the maiden edition we did redistribute the metrics, and of course with a wider metrics now you also redistribute it so that a different evolving aspect of bank is all captured in the report. Take for instance the digital income, it's now captured, and then we have the governance also captured. As I said, the profitability also captured. So that's what this particular one captured, so that in calibrating bank we know that really it's all encompassing. When we say these ones are tier 1, truly that they are tier 1 in every aspect of it.
A major takeaway from the second edition of the Tier 1 Bank Report launch is the reality that banking is evolving and the business models are changing. The key issues remain the need for banks to strengthen risk management, deepen financial activities, explore more customer-centric models, and explore more avenues to achieve sustainability.